Hi all, and welcome back to another episode of the ICIS Energy Foresight podcast. I'm here today with Matthew Jones and Lewis Unstead, and we're gonna look about winter 2023. Welcome, guys.
Hello.
So winter is here finally, and after we could say a turbulent fall with a lot of geopolitical events disrupting the market in some form or the other. What we are seeing is that prices are coming down, both on the power side, on the gas side, and on the carbon side, which is quite in line with what we expected and predicted in our EU winter outlook. For all the fans, it's available on our website, or ICIS.com. But guys, can I help you to? Can I ask you to help me draw a picture of this 2023? What has happened on the power side, and how has that impacted the carbon price and the carbon market?
So, on the power side, the most significant trend is the one that we talked about a number of times on this podcast previously, which is the massive decline in demand that we've seen. So across Europe, demand down 5% versus last year, around 7% versus the 5-year average from 2017 to 2021. And that's because of the high price environment that's impacted industrial demand. And we've seen some behavior changes on the residential side as well. But at the same time as we've had that demand decline, we've also seen a significant increase in renewables. That's both expansion of solar and wind capacity, and then also substantial improvement in the amount of hydro generation compared to last year, where it was very low. So this combination of decreasing demand on the one side, increasing renewables on the other, has meant that fossil generation has fallen significantly. So it's about 23% down on last year, around 30% down versus the 5-year average. And that obviously has a knock-on impact on power sector emissions.
Yeah, I think to add here as well, what does this mean for the carbon market? Well, last year we saw power sector emissions relatively bullish. We were up 3% in 2022. This year, the dynamics have completely changed, and we've seen a reversal of this bullish trend, and they're largely due to the reasons that Matt has just outlined there. I think low power demand is the key headline for the carbon market this year, because not only has it meant there's been a pressure on fossil fire generation, we've seen lower emissions from that, but also it's an indicator of industry emissions as well. The low power demand trend is in part a reflection of the manufacturing crisis that we've seen emerge within Europe and the price-induced demand destruction. This is therefore a reflection of a double bearish trend for EU ETS emissions. Not only have you got low power demand driving lower power sector emissions, but industry is also very bearish this year for emissions, and this has really set us up for a weak fundamental outlook. On the prices, well, this bearish fundamentals have really capped the bullish developments for the EUA market. We've seen, it'd be very difficult to take a bullish view in this market this year, and the participants that were once quoting the kind of plus 100 euro price level have become rather quiet over the recent months. So it's really been a story of the bearish fundamentals which have capped the gains, and this is where we see the price around 75 euros as we're recording this podcast today. So this has been the headline: bearish fundamentals capping gains for EUA price.
So we can say that both power and carbon have decoupled from Bitcoin this year. But jokes aside, when we talk about emissions are down, what are we talking about? Say in terms of absolute volumes this year compared to last year?
Well, in terms of absolute volumes, looking at our forecast, we were down in the power sector around 120 million tons on the end of the year versus last year. Looking at the generation data, power sector emissions, we estimate around 25% below last year's levels, which is massive. And when you compare it to the generation we've seen in 2020, for that same period, amid the COVID-19 lockdowns, we're still 8% below 2020 levels this year. So really, it's been a story of a low emission trajectory in the power sector, and it's meant that our market balance for the EU ETS is much less tight than we've seen in previous years.
That is pretty interesting, Lewis. And I think that there's another element that we haven't talked about, but we need to consider, obviously, the idea that demand and lower fossil generation is having an impact on hedging, which is something that plays quite a big role in how you trade forward. So can you guys help us understand a bit more what kind of hedging patterns are we seeing as a consequence of that, and how they're going to play out next year or so?
Sure. I mean, the headline is that utility hedging is lower this year than what we've seen previously. The key indicator for this would be the open interest data. And looking at that, we see for Germany, the year plus one contract, you've got open interest down 5% on last year. And then for the year plus two contract, we've got open interest down 16%. So the open interest data is a good proxy that power hedging is lower than what we've seen in previous years. The drivers, well, firstly, it's a question of demand again. And low power demand ultimately is translating into utilities selling less power forward, which is supporting a lower trend for hedging activity. The second driver here is really looking at the behaviour of utilities and their hedging speed. What portion or what percentage of future generation are utilities selling forward today? Last year we saw this collapse because of the high margining requirements and low financial constraints associated with hedging through utilities. This year, the situation remains still largely affected by high margining requirements, and so hedging speed also is down. Utilities are not hedging forward as much as they would have done in previous years. And utilities ultimately remain very cautious on the hedging outlook as demonstrated in their reports.
Yeah, I agree with everything you said there, Lewis. I mean, just to add a bit on the margin costs, they've been extremely high over the last 18 months, and they're only recovered on the delivery of the contract. So you've effectively got companies with a lot of money tied up in those trades that reduces the amount of money they have to open new positions on the market, and that will still be there for the next year or two until those positions are closed. You've also got higher collateral requirements with the exchanges. They've gone up over the past year or so it's effectively more expensive to trade on the exchange. And then we've got spark spreads, which are pretty negative for next year at the moment. So those gas-fired producers are not incentivized to hedge forward their baseload volumes for next year.
Super interesting, guys. I think this is one of those dynamics that you have to have front and center to understand the evolution of prices, because it basically taps into who is playing and the behavioral component of that and how that is changing over time. Super interesting. Closing up and looking again to the angle of price forecasting. Can you, and I don't want to spoil our 2024 outlook, but can you give us a little bit of a heads up of what are the factors that we should monitor next year?
Sure. So I think that the most interesting one to look at on the power side is, again, what happens with demand recovery. So our current expectation is that we will see some demand recovery next year, but it's going to be pretty slow. So we've still got some signs of permanent demand destruction, prices remaining too high for some industrial activity. And our base case assumption at the moment is for a 3% increase in demand next year, which is obviously for the carbon side slightly bullish for emissions in and of itself. But we expect that to be more than offset by what's happening on the renewable side. So further increase in the deployment of wind and solar in particular, and that eats into the fossil share. So what we're currently expecting is actually a very small decrease of around 1 to 2% in thermal generation year on year within Europe. And then the question becomes one of fuel switch. So at the moment, as I said in answer to the previous question, spreads are pretty negative for gas, and they're very much in favour of coal. So our modelling is suggesting that actually we get a slight increase in coal and lignite generation next year and a decrease in gas-fired generation. But of course, if we do continue to see some bearishness in the gas market, then we will see fuel switch. So more of that gas fleet moving ahead of some of the coal fleet within the merit order, with the impact that then has obviously on the carbon side, which Lewis can talk about.
Yeah, and for EUAs, we take a relatively neutral to bearish outlook for 2024. Couple of key drivers here. Number one, and this leads on from Matt's point, is that we do see a limited recovery expected in emissions, which have been very low this year and are likely not to see a big rebound in 2024. So on the demand side, it's weak recovery. On the supply side, the EUA market has got a big wave of additional supply that's about to enter this market, around 86 million tonnes of additional auction volumes that will come under the Repower EU package. This has been known by the market now and has been a hot topic since May 2022. However, the reality of that additional supply will mean this market will be less tight, and hence this is a factor that's shifting the balance slightly towards a market that is more bearish than bullish next year. And where we see prices, well, it's looking like below the €80 level for the first half of next year. The market's there already, and we believe this is largely because participants are pricing in the outlook for 2024 amid a lack of new fundamental drivers. So we really feel the expectations align with our forecast. And in terms of the key events, a couple of highlights really. We've got a new sector joining the EU ETS next year, the maritime sector. So shipping will be included. This is a new player, a new agent. Everyone's got questions about how these guys are going to act in the market. Will they hedge volumes? What sort of emissions they will produce? So these are question marks. The other one that Matt mentioned is the fuel switch. And I think for the short term, this will be a key price signal for the EUA market. Currently, the forward curve implies that coal is going to be running ahead of gas for the average efficiency plants. I think an open question that maybe is good to discuss in our 2024 outlook is what happens if this is not the case and we see the spreads switch and actually we can burn some extra gas in the power sector this winter. Then I think the story could become a little bit more bearish for EUAs than we currently see.
Interesting. And Lewis, one anticipation on the policy side. Can we expect the 2040 target next year?
Yes, with certainty, Matteo, with certainty. It's in the legislation. So the 2040 target is going to be published by the Commission in Q1 next year. They simply have to do it, and this is what they've committed to. So 2023 for the carbon market has been a year where policy has really been out of the spotlight. We haven't seen many new proposals, and it's not been a focus for the market. So next year, attention for EUA market participants is going to turn back towards Brussels, and we're going to be watching what happens there. So it'll be the 2040 climate target. It's going to sit somewhere between 85 to 95%, and I think the Commission is going to be pushing towards a target above 90%. For us, it's a key question of will that survive the Parliament and Council, and where sometimes climate ambition goes to die. So we have to see what happens with that. But we're going to get it next year. So look forward to digesting what that means for the EU ETS.
Yeah, and it's going to be an election year, so it's going to be pretty interesting.
Yeah, exactly.
All right. Thanks again, guys. It's been very, very informative and interesting, as always. You can find anything on our website, ICIS.com. Hope you have fun and have a nice end of the year. Goodbye.
Cheers.
Bye.